All right. Okay, good evening, everyone. Welcome to today's webinar. Again, I'm really happy to be able to interact with you. And this is already quite a number of webinars that we have done over the past half a year. And of course, today's topic is actually on how to swing trade with precision using Japanese candlestick. I'm sure many of you would have opportunity to heard about or read something basics about Japanese candlesticks before. And very often it takes quite a bit of experience and learning before you can actually use Japanese candlestick effectively. So in today's webinar, what I'm going to do is I want to share with you some of the important things, foundational things about Japanese candlestick, and how what are some of the Japanese candlestick reversal patterns that I personally like to use to share with you about how to use them. So let me go into the slides mode so that I can continue sharing with you more things about Japanese candlestick. All right. So let me just give me a moment. All right, so okay, so today's topic is on swing trade with precision using Japanese candlestick. And the agenda for today are as such. I'm going to be sharing with you some of the advantages and disadvantages of using a candlestick pattern strategy. Well, the things I've always firmly believed that anything that in life has got both its pros and cons. And before you all go deeper into using candlestick for your trading strategy, I think it's rather important for me to share with you what are the pros and cons of using this particular strategy so that you can decide for yourself whether that will be helpful for you or not in time to come. And of course, secondly, in the second segment of today's webinar, I'll be sharing with you 5 of the most powerful candlestick reversal patterns that I personally like to use or like to look out for. And I'll be sharing with you how to actually understand the psychology behind these 5 different kinds of reversal patterns and how to actually apply them when you make your trading decisions. All right. And finally, after sharing with you those 5 candlestick reversal patterns, I will share with you my step-by-step process in terms of how to actually use candlestick patterns to analyze and even initiate and execute a trade. All right. So let's go. Okay. Just some important notes for you to take note of is that for today's webinar, I'll be sharing with you some examples here and there. I just want you to note that those examples are not meant to provide you any kind of trading ideas, but really meant for you to use it as educational material, right? Now, for those of you who is actually attending this webinar for the first time, or this is the first time you are hearing me or seeing me, I just want to quickly share with you a bit about my background so that you can understand from what kind of perspective am I able to be here sharing with you about all this trading strategy and trading workflow and best practices, right? So ironically, although I've been conducting seminars and webinars and teaching people and applying technical analysis, I actually started off as a very passionate fundamentalist, and that was before I joined the financial industry as an investment analyst more than 10 years back. It was really by a stroke of chance that I was offered a position as a technical analyst, which I was initially very hesitant to take it up because I came from a perspective of being a very passionate fundamentalist. But subsequently, I decided that, okay, I just want to try it out to see how technical analysis is like. And I accepted the job. And during the period where I learned how to become a technical analyst, I spent a lot of time, probably about 3 months, going through at least 50 books on technical analysis, trading, psychology, trading, strategy kinds of books. And during the 3 months, I spent every single of my working day looking through hundreds of charts on a daily basis across Singapore market, Hong Kong market, and US market. And I started to realize that during the 3 months that there are really a lot of useful and very important aspect of technical analysis or studying price charts that when I was a passionate fundamentalist, I didn't realize how important that was. And guess what? I became a very devoted technician after that particular 3 months of experience. And subsequently, I just stuck on to being a technician and using the art or the science of technical analysis to make my investing and trading decisions. And interestingly, I was the chief technical analyst for OCBC Investment Research for about 8 years, but I left them about 2.5 years back. and to become a visionary technologist. And that was how I started TraderWave after I left them. And for those of you who doesn't know what TraderWave is, so TraderWave is actually a 100% web-based charting application that I envisioned building for traders and investors, so that they are able to actually get access to a really high performance and very responsive web-based charting application. So this allows the user to be able to seamlessly access charts all the way from smartphones to desktop computer. And at the same time, TraderWave right now, we actually covers more than 16 stock exchanges in Asia Pacific, and we are in the midst of launching currency as well as cryptocurrency as well over the next 1 month. So keep a lookout for that. And at the same time, we allow a trader user to actually set personalized chart-based alerts. We will actually help you to monitor on the cloud, and then we will actually notify you when any of your trading alerts are being triggered. So right now we have alerts like trend line alerts as well as horizontal line alerts, but we will push out more types of alerts in the months ahead, things like dividends, announcements, and stuff like that, as well as trading volume, which are extremely helpful in terms of helping you to find good trading opportunities. Okay, so before I go on, just want to do a very quick poll. Can all of you just let me know? So my colleague Gladwin will launch a poll soon. So can all of you just let me know, are you currently a TraderWave user? And that's the reason for me actually asking this question. And the reason being is because later on I will have a very nice offer for those new TraderWave users towards the end of the webinar. So if you are keen to know what this offer is, please stay on until the end of the webinar. I will share with you more on that. All right. So meanwhile, just help me fill up this poll to let me know if you are currently a TraderWave user or not. All right. So let's officially start today's webinar. But before I go into what Japanese candlestick reversal patterns is all about, I think it's important for me to just quickly run through with you what is a Japanese candlestick in the first place, especially for those of you who have no idea what Japanese candlestick is about. So very quick history. Japanese candlestick in itself, the science or the art of Japanese candlestick is really a study of the emotions, sentiments, and psychology of the market participants. In fact, in the space of technical analysis, I really couldn't find any kinds of technical indicators or overlays or other technical studies that could be a better study about the emotion and the sentiments of the market participants compared to Japanese candlestick. And that's the reason why I personally think Japanese candlestick, or the understand and the use of Japanese candlestick, can really help a trader a lot. And so Japanese candlestick was actually being attributed to a legendary rice trader named Munehisa Homa back in the 1700s, long time, centuries ago. And in fact, his trading principles was actually applied to rice markets at that point in time, and it subsequently evolved into candlestick methodology. That's the reason why we often call candlestick as Japanese candlestick, because it originates from Japan through Homa, according to the attribution. All right. So what is actually a candlestick, and how do we actually know what does a candlestick means? So over here, I've shown you two candlesticks. One is a black candlestick and a white candlestick. So these are the typical aspect of candlestick that you need to know in order to understand what is going through in the market as you look at the candlestick. All right. So for a black candlestick, you actually see the opening higher than the close. All right, over here, and that's why a candlestick is black. If you have the open, which is lower, or the closing price is higher than the opening price, then you actually see a white candlestick. So usually on a charting software, you will automatically change the color depending on whether the opening or the closing is higher or lower. And you can see over here towards both ends of the candlestick body, there's actually a wick coming out or a shadow coming out. That's what we call the intraday high and the intraday low. So both ends is the intraday high and intraday low, right? So this is the anatomy of a candlestick. And so now that you know what is the construction of one candlestick, then what exactly are reversal candlestick patterns? So reversal candlestick patterns are basically a sequential appearance of between 1 to 5 candlesticks in sequence that, when it shows up, suggests a likelihood of a price trend reversal. Okay, and I want to emphasize again the point about likelihood. It doesn't mean that if you see a sequential appearance of a certain candlestick pattern, it means that 100% sure this will be a price reversal. No. Okay, like anything in trading is always about probability and likelihood. So when you see a sequential appearance of this kind of candlestick patterns, it suggests a likelihood of price trend reversal. And what we want to do is to make use of this or take advantage of this kind of likelihood to help us get into a trade with a likelihood of making money out of it. All right. So as you can see over here, I'm just showing you a few different kind of varied examples of a reversal candlestick pattern. So as you can see over here, some reversal candlestick pattern is just consists of one candle, some consists of two, some three, and some 5 candlesticks. All right. So I will explain more on that to you later on. Right. Right. Next. Right now, I'm going to be sharing with you the advantages and disadvantages of a candlestick pattern strategy, okay? Because I think it's important for you to understand the pros and cons first, so that later on, as I give you more examples, you can relate all these pros and cons directly into applying candlestick reversal pattern strategy, right? So the pros, the good things about a candlestick strategy, firstly is candlestick patterns or candlestick itself adds an additional dimension to other forms of analysis. So essentially, candlestick is not meant to replace things like technical indicators. It's not meant to replace things like support resistance level or replace trend lines or to replace moving average. No. So the good thing about using candlestick strategy is that it can actually be layered on top of the rest of the other strategies that you use. It's not meant to replace, but meant to add a more stronger dimension to it, so that it gives you a more confidence level in terms of getting into a trade, right? So that's the pros of a candlestick strategy. And the good thing about candlestick strategy is that it is highly visual. So highly visual, for human beings, we are not that good at looking or crunching numbers directly and trying to make sense out of it. But generally, human brains or our visual, our eyes, are very good at looking at patterns and be able to derive a certain perspective just by looking at patterns. That's the reason why candlestick can be very easy to grasp visually for most people. And that's why it's actually very helpful. And thirdly, what I really like about using candlestick strategy is that it provides me a very clear stop loss zone to consider. Okay, because without candlestick, sometimes it's more difficult to find exactly where a stop loss level is going to be. And again, I want to emphasize stop loss is extremely important. All right. Now, what's the downside of using a candlestick strategy then? Since I've shared with you the pros of it, one of the downside of using a candlestick strategy is that candlestick reversal strategy does not provide you a price target. So you can use a candlestick to initiate or to come up with a trading idea. You can use a candlestick pattern to help you establish a stop loss level, but you can't use a candlestick to actually help you provide a price target, at least not when you first enter a trade. All right, but if let's say you do not have a predetermined price target and you let your price target run over time, then candlestick strategy can potentially become help you establish where you can potentially take profit, but it doesn't help you establish a price target right at the start of the entry. All right, so that's the downside of it. And usually for candlestick, you will have to wait for a confirmation the following day, even after you have seen a candlestick pattern emerging on, let's say today, you have to wait for a confirmation the following day before you can actually get in. So that is one of the downside of it. You've got to wait for one additional day before you get into a trade, usually. All right. And lastly, great candlestick reversal setups or patterns do not actually show up very frequently. So if you are the kind of trader that you just look at 5 to 10 stocks, then you might not be able to see candlestick reversal patterns happening that often. And that is also one of the reasons why I usually advocate, if you are serious about trading, it is important for you to actually have a reasonably a big list of stocks to be looking through very quickly and very frequently, so that there is more opportunities of you being able to see great candlestick reversal happening in the huge list of stocks that you might be scanning through regularly. All right, so that's the downside of candlestick. Good reversal setups do not actually show up that frequently. As such, you've got to have a bit more patience if you do not scan through a huge list short list of stocks and their charts. All right, so Right now, I will move on to the segment about sharing with you what are the 5 most powerful candlestick reversal patterns that I personally find it to be the most useful. So as some of you would have known, if you are exposed to candlestick patterns or you have tried to read up on candlestick itself, you will realize that there's many different kinds of candlestick reversal patterns or even continuation patterns out there. And so these are just some very quick examples that I'm showing you. So if you're not initiated and if you do not have experience with candlestick patterns, this might be overly overwhelming for you, okay, which is perfectly normal. And that's the reason why I want to help you shorten your learning curve at this point in time to just share with you 5 of the most important and powerful candlestick reversal patterns so that you can use those 5 reversal candlestick patterns as your foundational knowledge in terms of applying candlesticks. And then once you are very familiar with those 5 main types of reversal patterns, you can actually start to expand your scope and your knowledge about the rest of the other candlestick patterns. All right. So the first candlestick pattern I want to share with you, which is one of the most useful candlestick reversal pattern, is actually the pin bar reversal pattern. Okay, so what is actually a pin bar, right? So a pin bar in a Japanese candlestick naming convention perspective, it can also be called a hammer or inverted hammer. All right. So what actually constitute to what we call a pin bar? So firstly, a pin bar is a one single candlestick that has a very small body and a very long shadow, or what we want to call a long wick if we are talking about candles itself. So in this case, what you can see over here is that this is an inverted hammer, right? A hammer that is heading down. So this is an inverted hammer. As you can see over here, this is the body, which is a green part, and the body, which is the red part. So which means that the open for the green part is the open is lower than the close, while for the red one is the open is higher than the close. And when you have a very long shadow pointing up, that's what we call an inverted hammer, which is a type of pin bar. All right. So the shadow usually have to be at least about 2 times or more the length of the body itself in order for us to call it a pin bar or a hammer or a hammer. All right. And lastly, one important thing is that at the other side of the body of the candle, there generally should have a short or even no shadow on the other side of the body. So as you can see over here, the 2 candles at the top is what we call an inverted hammer, while the 2 candles below over here is what we call the hammer candlestick. All right, and all of them belongs to the family of pin bar. Right. So how do we actually use pin bar reversal pattern then? So for a candlestick reversal pattern to be valid in the first place, there is always one very key criteria that needs to happen. It means that for a bullish candlestick reversal pattern to happen, the prior trend has to be down. Okay, the previous trend has to be down, right? Otherwise, how can you reverse into a bullish pattern? How can you bullish it into a bullish trend thereafter? So in this case, I can see over here, this is what we call, the green one is what we call a bullish pin bar. So previously, the prior trend has been going lower. Then suddenly you see this hammer candle happening, or what we call bullish pin bar appearing. And then subsequently, if the price starts to go higher from there, we deem that there's a likelihood or a good chance that the price has reversed and will continue to go up from here. So vice versa, bearish pin bar is with the actually the shadow and the wick pointing high into the sky. And the prior trend is actually previously was going up, and then a bearish pin bar appears, and then there's a likelihood that it will reverse and go down from here. So how does it look on a chart basis? These are 2 examples of showing you how a bearish pin bar and a bullish pin bar looks like. So for the chart on the left hand side, you can see that over there at this point over here, there's actually a inverted hammer that has a long shadow pointing up to the sky. All right, and this is what we call a bearish pin bar. So as you can see, the prior trend was actually up, and when this pin bar happens at a key resistance level, and following the next day, it actually closes lower with a black candle. So that suggests that the likelihood of it falling or reversing from here is very high, and that's the reason why it really started to fall thereafter. So for the diagram or for the chart on the right hand side, you can actually see that there's a pin bar that appear after a minor pullback on a major trend. So when this bullish pin bar appear, and then the next day it opened close higher, and that's when it start to go into an uptrend again. All right, so these are the typical scenarios where you will notice a pin bar reversal pattern happening. right? So a few things to note when you are applying pin bar reversal pattern. Okay, firstly is that the longer the shadow and the smaller the body, the more important that, or the more significant that pin bar is. All right. So next time when you see a pin bar, you think that, I'm not sure whether this is a pin bar or not. Then most likely, it is a pin bar that has quite a big body, long body, and a short shadow. All right. So when a pin bar is very obvious, it will actually jump out at you because you will see a very long shadow and a very small body. All right. That's when you need to take note, because when you see pin bar appearing, and you need to watch out for what is the next day's closing price. All right. And then a second thing to note about pin bar is that pin bar reversal direction should be in line with major trend or sideways trend. What does this mean? It means that, let's say you notice a bullish pin bar appearing, okay, in a prior minor downtrend, you should take a look at what's the major trend. Is the major trend still up? If the major trend is still up, then you are looking to trade this bullish pin bar. But if the major trend is down and you see a bullish pin bar appearing, then you shouldn't actually try to trade this bullish pin bar because the major trend is still down. So later on, I will show you an example on that. So thirdly, pin bar should appear near to support or resistance level. If a pin bar appear out of nowhere, you can't establish any kind of support or resistance at where the pin bar appear, then the significance of the pin bar might not be as important. All right. And ideally, when you see a pin bar appearing, you don't want to get into a trade straight away. Okay, you want to wait for a confirmation the following day. You want to see that after a pin bar appear for today, next day you want to see the closing higher than where it closed on the pin bar day. All right, and finally, stop loss to be placed at the tip, at the end of the pin bar area. All right, so how does all this play into the picture? I will show you examples later on. All right, so the second candlestick reversal pattern is actually, which is very helpful, is the engulfing reversal pattern. All right. So engulfing obviously has a bullish nature to it as well as a bearish nature to it. But what a basic engulfing patterns entails is this. Firstly, in order for a candlestick pattern to be called an engulfing reversal pattern, candlestick pattern, the first candle has to start with a small body, generally a small body. So as you can see over here, this is a small body. All right. And then next, the second candle following the first candle, it should have a big body, and usually it's an opposite color. All right, you should have big body, and the body should actually cover the entire body of this first candle. Okay, so this is the third point, where the second candle's body must totally engulf. That means totally contain the length of the first candle's body. Right, so this is an example of both a bullish engulfing candlestick pattern as well as a bearish engulfing candlestick pattern. All right, so as you can see over here, for a bullish engulfing pattern to be valid, okay, firstly, the prior trend has to be down first. All right, so a prior trend is down, then you see the first candlestick with a small body is red, which is a down day. Then after that, the next day, the second candlestick you see is a green candlestick, okay, which engulfs the entire body of the first day candlestick. And this time is a green color candlestick, which means that the market actually opens lower but close higher. So psychologically, this means that the market initially was pretty bearish, right, based on the prior trend. But as it opens lower, the market was so bullish that they were able to push the price all the way to close higher than the previous day's opening price. So generally, this means that the market is generally quite bullish. And then once you have a confirmation candle on the third day, where the closing price was higher than the second day, that's when you have a confirmation, and that's when you actually look at initiating a trade based on this bullish engulfing reversal candlestick pattern. All right. And for this particular diagram, you will also notice that stop loss, this is where you can actually put the stop loss. You can put the stop loss just below, anywhere below that the last limit of the support level of the bullish engulfing pattern. So bearish engulfing pattern, vice versa. I don't want to elaborate further on that, but it's basically just the opposite direction. All right. So this is how an engulfing reversal pattern looks like on the chart. Okay, so this is an example of what happens when you see a bullish engulfing pattern on the chart and a bearish engulfing pattern. So as you can see over here on the left side chart, you notice that the prior trend was actually down. Then on the first day of candlestick, you notice that is a black candlestick. Okay, but of course, when this first black candlestick comes out, there's nothing that you can establish based on candlestick patterns yet. It was only when the second candle on the second day, the candlestick comes up, opening lower and engulfing the entire body of the first day candle and close higher than that. That's when we establish that, wow, this looks like it's a bullish engulfing bar. All right. But even with this bullish engulfing bar, can we establish that it will definitely reverse or very likely reverse already? Not yet. We still need a confirmation day on the third day, right? So as you can see over here on the third day, it actually closes higher than the closing price of the when the second candlestick emerges. So that's when the confirmation happens, and that's when it becomes a very high probability or a good likelihood that the trend will continue to go higher from here. And that's when we, as traders, we initiate a trade to buy this particular stock or instrument. All right. So on the right hand side is an example of a bearish engulfing. As you can see over here, prior trend was going up, and then the first candlestick appears, looks nothing important, until when the second candlestick appears that engulfs the entire body of the first candlestick. And then on the third day, it closes lower than the second day. And that's when you have a confirmation, and that's when you get into a trade and then starts to initiate a short trade on this particular chart over here. Okay, and that's how an engulfing reversal pattern looks like on the real chart. So a few things to note is for engulfing reversal pattern, the more the second candle engulfs the first candle, the more important the pattern is, or the more significant this pattern is. All right. So if you have the first candle very small body, and then you have the second candle a very big body and engulf totally and a big part of the first candle, then that pattern is actually very significant. You need to take note and probably look at whether you want to trade that particular reversal pattern or not. All right. And secondly, engulfing reversal direction should be in line with major trend. Again, if you see a bullish engulfing reversal pattern, okay, get into the trade or execute the trade only if the major trend is up, but on a minor downtrend. Okay, so if, let's say for example, if you see a minor downtrend showing up with a bullish engulfing pattern, but the major trend is still up, then that is actually a viable opportunity to get into a long trade based on the bullish engulfing pattern, right? And next, engulfing pattern should appear next to support or resistance level. Okay, so when that happens, it becomes even more a higher confirmation that very likely that these reversal patterns will continue to reverse and go back in the other direction. And again, ideally wait for a confirmation on the third day, okay, the following day. And finally, stop loss to be placed just below the bullish engulfing pattern or just above the bearish engulfing pattern. Right. The third candlestick reversal pattern, which I think is rather important as well, is what we call the cloud or piercing reversal pattern. So the cloud or piercing reversal pattern is actually slightly a bit similar to the engulfing pattern, but it's not as critical as the engulfing pattern. So what do I mean by that? So for a cloud or piercing reversal pattern, what happens is that firstly, you will see a generally white body on the first day. Then on the second day, you will notice that it opens, in this particular case, this is what we call a piercing bullish reversal pattern. So the opening opens lower than the closing of the first candle. And then the market just start buying it, rallying higher, and then the price actually closes above the midline of the first day candle's body. Okay, so psychologically or by studying the psychology of the market based on this candlestick pattern, you'll notice that the market has turned strongly bullish on the second day because it's able to rally all the way and close into the upper half of the first day's candle's body. All right, that's what we call a piercing line bullish reversal pattern. Okay, so in this case, first candle, it has to have a long body. Second candle, also long body, but in opposite color. Okay, and the second candle need to close beyond the mid body of the first candle. All right, and as usual, when you see a piercing line bullish candlestick reversal pattern, in this case, you want to wait for a third day as well to see whether the closing for the third day actually closes higher than that of the second day. Right, so once you have that confirmation, that is a viable piercing bullish reversal pattern that you can potentially trade. All right, so this is an example of a piercing pattern. If you see below, it's a piercing pattern. Prior trend was down, then you see the first day candlestick, which is still down, Then you see the second day candlestick, which opens lower but close higher towards above the mid body of the first day candlestick. And that's when you have a piercing pattern emerging. Then you wait for a confirmation on the third day for it to actually close higher than the second day. That's when you start to initiate a trade or long trade from this perspective. All right. And vice versa, the opposite of a bullish piercing reversal pattern is what we call the dark cloud cover bearish reversal pattern. So for this dark cloud cover, prior trend has got to be up. Then you see on the first day, nothing fanciful, nothing critical. But on the second day, you notice that the candle opens higher, but closes lower and actually goes into more than half of the body of the first day candle. And then finally, on the third day, you see that the market or the price closes lower than the second day. That's when it's a confirmation and suggests that, okay, this dark cloud cover likely shows that there's a good chance that the reversal will happen from here and it will go down from here. And maybe we should look at having a short trade on this particular instrument. Okay, so on the real chart, this is how both a piercing line and a dark cloud cover exist on the chart at the same time. Okay, so as you can see over here for piercing, prior trend was down, long red candlestick, followed by a long green candlestick, opening lower but closing more than half the body of the first day candlestick. And then with the confirmation on the next day, okay, this suggests that it will continue to go higher from there. And after about 4 candlesticks higher, it go higher, then we start to see a dark cloud cover candlestick appearing. Okay, and that's when it starts to go down from there. Okay, but in this case, there wasn't a confirmation. All right, but this is the 2 candles itself is a dark cloud cover, except that it doesn't have a confirmation. All right, so things to know about cloud or piercing reversal pattern is the more the second candle penetrates into the first candle's body, the more important the pattern is. In fact, if the second day's candle moves so much such that it might potentially even engulf the entire first day candle. Okay, when that happens, a piercing line or a dark cloud cover reversal pattern becomes an engulfing pattern, which means that that is very, very important and significant. Right? So a cloud or piercing reversal pattern direction, you should always use it in line with the major trend, which means that if you see a dark cloud cover, you only want to initiate a short trade because dark cloud cover is bearish reversal, right? You only want to initiate a short trade if the major trend is actually down. All right. If we see a piercing bullish reversal candlestick pattern, you only want to initiate a long trade if the major trend is up or at least sideways. Okay. And thirdly, this pattern should appear next to support or resistance levels, like the most of the other patterns as well. It should appear near to support or resistance level so that it offers you another confluence factors to actually trade this particular pattern. And ideally, wait for a confirmation on the following day, on the third day. Of course, if you choose not to wait, it's fine as well, because there's always pros and cons to waiting for confirmation. All right. The pros of waiting for a confirmation is that when you see a confirmation, there is a higher likelihood that the reversal is really materializing and will continue to go in the direction from there. But if you choose not to wait for a confirmation, the downside is that the likelihood has not increased significantly yet, but you get a much better reward to risk ratio because you get in before the confirmation, right? Which means that your entry to your stop loss is actually narrower, right? Later on, I will show you more examples. And finally, stop loss to be placed beyond the end of the cloud or piercing pattern, which is regularly the same as the rest of the other reversal patterns, right? And the next one, star reversal pattern. Okay, so star reversal pattern, this is how it looks like. So what happens is that for a bearish star reversal pattern, you will see prior trend is going up, then you see a long white candlestick or green candlestick. Then suddenly you see on the second day, a small body of candlestick that is above the closing price of the first day candlestick. All right. And then on the third day, you will see that it actually closes lower than the second day with a long black body as well. So that's what we call a bearish star reversal pattern. So first candle with long body in the direction of the prior trend. Second candle with short or no body. Okay, so it could be a short or no body at all, which is what we call a doji. And it should usually be established away from the range of the first candle's body. Okay, and then finally, third candle with a long body in the opposite trend away from the prior candle body. All right. So in this case, the bullish star at the bottom part, you will see that it was a black candle followed by a small body. Okay, then the body didn't go into the range of the first body at all. All right, and then the third candle, when it comes up, also didn't touch go into the range of the second body at all. It opens here and then it closed significantly higher. So this is what we call a bullish star reversal pattern. All right. So for star reversal pattern, there are generally two types. One is what we call evening star, morning star, where you see a certain body. There is still a small little body that protrudes out from the top and the bottom. But when you see a cross happening, or this is what we call evening doji star as well as a morning doji star. So instead of having a body, there's totally no body at all, which means that the opening and the closing price is very almost at the same level. Okay, so this is what we call evening doji star or morning doji star. So all this belongs to the star reversal pattern. Okay, so if you see any of all these, you could potentially look at trading from the long side or the short side. So this is how an example of a star looks like on the chart itself. So prior trend was going up. Then on the first day, you see a long white candlestick. Second day, you see a star coming out with a small body and wicks on top and below. And you will notice that the second day's candle totally did not overlap the first day's candle's body at all. Not even the shadows at all. All right. And then on the third day, you will notice that it opens lower and then close even lower, and the whole body of the third day's candle did not overlap any of the second day's candle's body at all. Okay, so this is how we establish what we call an evening star reversal pattern. All right. So things to note for this star reversal pattern: the further away the second candle's body is from the first, okay, and the second candle, the more important the pattern is, which means that if the second candle is like suddenly pop up and is nowhere near to the body of the first candle as well as the third candle, then the more important it is. All right. And a star pattern reversal direction again, okay, should be in line with a major trend or sideways, which means that if you see an evening star bearish reversal candlestick pattern, you will only want to short this trade, okay, because it's a bearish reversal, right? So you want to short this trade only if the major trend is down. Okay, if the major trend is up and you see a evening star bearish reversal candle, then you better don't try to short it, right? And star reversal pattern should again appear near to support or resistance level because it helps you further have a confluence factor to it and likelihood that you will continue to reverse in the direction, all right? And a third candle is vital for star reversal pattern. If without the third candle, this is not even as a confirmation. This is vital in order for a star reversal pattern to be valid in the first place. The third candle must be present. It means that it must open below the body if it's an evening star and closes even lower from there, right? Stop loss has to be placed beyond the end of the star reversal pattern. If it's a bearish star bearish reversal pattern, then it has to be at the top above the star. All right. If it's a bullish reversal pattern, it has to be at the bottom of the star. Okay. And finally, the other most important candlestick reversal pattern is what we call the harami reversal pattern. All right. So how does a harami reversal pattern looks like? Okay. So same thing. Prior trend. Let's say in this case, for example, prior trend was up. And then on the first day, you see a long white candlestick, okay, happening. Initially, when this long white candlestick emerges, it still looks very bearish, right? Okay, but the thing is, on the second day, suddenly, the opening price actually comes in lower inside the body of the first day candlestick, and then it closes lower or it closes higher, but it has a very small body. What this signifies is that the market is starting to get a bit neutral or starting to get a bit less bullish. Okay, so when this small little body appears within the body of the first candle, it only signifies that the market is becoming more neutral or starting to hold back its bullish stance, but it doesn't necessarily mean it's going to reverse yet. And that's the reason why for harami reversal pattern, it is very important to wait for the confirmation pattern, okay, to tell you that there is a high chance that it has reversed already. Okay, so for harami reversal pattern, first candle long body in the prior trend. Second candle with short or no body, okay, and it must be within the range of the first candle's body. Okay, so the second candle, okay, when it appears, whether it's bearish or bullish reversal, it doesn't matter. The second candle can be black, can be white, or it can even be a doji, which is basically like a cross with the same opening and closing price. right? So this is how a Harami reversal pattern looks like. Generally for Harami, there's two classification as well. One is what we call the bearish Harami. So in this case, it has a body, okay, on the second candle. Or there's also what we call a bearish Harami cross. Okay, the cross is when the second candle doesn't have a body at all. It's a cross over there. Okay, so you can see over here, bearish Harami, it reverse back down. Bullish Harami, it reverse backs up. All right. And so this is an example of how it looks like on the chart itself. So example of a bearish Harami is prior trend was going up, long white candlestick, everything looks perfect and bullish initially. Suddenly, you see a candlestick, a small little body candlestick appearing within that long candlestick. All right, that's what we call a bearish Harami. All right, and on the bullish Harami side, you will notice that it was prior trend was going down, and then you see a small little body happening inside within the range of the first body, and then on the third day, it actually closes higher. That's what we call a bullish Harami pattern. All right. So things to note for Harami: the smaller the second candle's body is compared to the first candle's body, okay, that means the more important or more significant that pattern is. All right, the smaller the second candle body versus the first candle's body in terms of proportion, the more important or significant the pattern is. And Harami reversal direction should be, again, be in line with major trend. If you want to trade a Harami bullish reversal candlestick pattern, only long in the if the major trend is on its way up as well. Okay, Harami reversal pattern should appear near to support or resistance level, same thing. And a third candle, again, for Harami is very, very important. Without the third candle confirmation, don't trade a Harami pattern just based on the first two candles, right? And again, stop loss to be placed beyond the end of the entire Harami reversal pattern, okay? Depending on whether it's a bullish reversal pattern you are trading or a bearish one. Okay, so I have just gone through with you the 5 key candlestick reversal patterns. So these are really the most foundational candlestick reversal patterns and the most useful ones. In fact, if you just apply these 5 types of candlestick reversal patterns, you don't generally have to occupy yourself with the rest of the other candlestick patterns as well, because there can be just too many for you to remember. All right, so if you can just be very well versed with these 5 types of candlestick reversal patterns and apply them diligently and look out diligently for them appearing on the charts, this will be extremely helpful for you. So what I'm going to do right now is I'm going to go through a step-by-step process to how I actually use candlestick reversal patterns in my trading. All right, so this will start from all the way from analysis until executing a trade itself. So usually the first step is assuming if I have a long list of charts that I look at. All right, firstly, before I even think about executing a trade, I want to know what is the existing major trend first. Okay, so in this case, as you can see over here on this particular chart, when I look at this chart itself, it is very clear. I draw an uptrend line over there, as you can see over here. It is definitely still in an uptrend within this particular time frame that we are looking at. Okay, so we can establish that this is now still in a uptrend. All right, so next, once you know that it's an uptrend, what is the kind of candlestick reversal pattern you want to watch out for to trade? Okay, we don't want to look for bearish reversal candlestick patterns to trade in a major uptrend like this. For a major uptrend, we want to look for the emergence of bullish reversal candlestick patterns. All right, so as you can see over here, as the market develops, as the price develops, what happens is we notice this is what we call a pin bar, right? A pin bar reversal pattern, right? Okay, because major trend was up, minor trend was down. So this was the minor prior trend. It was on its way down. Then suddenly we see this pin bar happening with a very long shadow, long tail, okay, with a small body. And then on the third day, there's a confirmation because it opens higher and close even higher. All right, so this is what we call a pin bar, or what we call a hammer bullish reversal pattern. All right, so this is we want to observe for candlestick reversal patterns or bullish reversal candlestick patterns in a major uptrend. All right, so if this is not a pin bar, it could also potentially be an engulfing, bullish engulfing pattern happening over here. Otherwise, it could also be a piercing line bullish reversal pattern happening over here. Or it could also be a morning star, okay, pattern appearing over at this place over here. Or it could also be what we call the bullish Harami pattern happening over here. All right, so you can just imagine, you can actually keep a lookout for whether it's this candle, this candlestick pattern, this pattern, or this pattern. Any of the 5 patterns happening at important level, that is when you want to watch out for an opportunity to trade. All right. So the next, which brings me to my next point, the third point about the next important step I will go through in trading a candlestick reversal pattern is this. The candle reversal patterns have to exist together with a few other confluence factors. And these are two of the most important confluence factors I like to use together with candlestick reversal patterns in order to help me determine that, okay, this is the time for me to actually get into a trade. And this is the one. Firstly, as you can notice over here, when the candlestick reversal patterns emerges, you can actually see that it actually emerged at where that key uptrend support is. Okay, and at the same time, do you notice that where the candlestick reversal pattern happens, it was also at a very key resistant, previously resistant break above becomes support level. So it also happened at a key support level. So do you realize that there's three confluence factors happening together at the same time? Firstly, you have a bullish pin bar reversal pattern happening at a key uptrend support, which also happens to be a key resistance turn support level. So you have three confluence factors happening at the same time. And this is the kind of situation you want to initiate a long trade on in this particular example over here. All right. So now you have noticed that these three key important confluence factors is happening and you decided that you want to get into this trade. The next thing you need to do is, okay, when should I actually enter this trade because of this, due to this bullish candle reversal pattern? Okay, two scenarios or two occasions you can actually get into this trade itself. Firstly, you can actually get into the trade towards, okay, the closing session, okay, of the confirmation day, which is in this case the third day for a pin bar reversal pattern is on the third day. So you can either enter a trade as it is about to close, as the market is about to close, and you still see that the third day is still closing higher than the previous day. You can actually get in towards the close. Alternatively, if you do not have the time to get in intraday, you only have the time to look at the charts or look at what happened after that, after the market close, you can also consider getting in on the next days after the market has opened. That means on the fourth day. That means the day after that confirmation day. Okay, so you can get in when the market opened, and if things looks like it's still hovering well at that level, you can actually get in after the market opens on the fourth day in this case. All right, so that's two areas that you can potentially get into. And once you decided that where is an estimated entry level, you need to decide on the stop loss level. This is very, very important, okay? And I always advocate, as a trader, you always want to establish a stop loss level before you get into a trade and stick to that stop loss level, okay? And so in this case, I shared quite a number of times earlier on how to actually determine a stop loss. Very simple, okay? You put your stop loss at a certain distance below the lowest point of the reversal candle. So as you can see over here, the reversal candle, the tip of the shadow, okay, that is the point where your stop loss level should at least be that level or even lower. So as you can see over here, this arrow zone, the zone where I mark out with the arrow is the zone where it is the most likely place you should put your stop loss. Then you might ask me actually, should I put it towards the upper range or put it towards the lower range? There is no right or wrong answer to this, okay? There's only pros and cons to putting either nearer to the shadow, to the tip, or further away from the tip. You put nearer to the tip, more likely to get stop out, okay? But at the same time, you have a much better reward to risk ratio. If you put too far away from the tip, then you are less likely to get stop out, which means that more likely you have a profitable trade, but the reward to risk ratio will not be as good. All right, so I've emphasized this many times before in my previous webinar. So just take note of this. There's only pros and cons. There is no best area or best level to put that stop loss. And once you have determined your entry level as well as your stop loss level, you can generally estimate a profit target. All right, so as I said earlier on, you can't use candlestick reversal pattern to establish your profit target. So you will have to use other ways to establish your profit target. Either you could use trend channel, or you could be looking at what is the next key resistance in this case. Okay, you want to ensure that based on your profit target level, it has a worthwhile risk to reward ratio of at least 1:2 times. All right, so anything less than that, usually I would not want to get into the trade because I think that it's not worthwhile. Right? So once you have established your entry, stop loss, and profit target level, that's when you need to start sizing your trade. This is also a very, very crucial and important stage where I want you to remember, okay, sizing your trade. So let's take a look at the same example over here. Let's assume that we have a $100,000 account size. My general suggestion for traders is that do not risk more than 5 or 0.5 or 1% of your total account size on any individual trade. All right. So in this case, you can actually calculate the number of shares as long as you have your account size, the percentage you are taking a risk on, as well as the entry level and the stop loss level. Okay. So there's a method to calculate the number of shares to buy is take 1% of your account size, in this case, $100,000, divide by the difference between your entry and stop loss level. Okay, so if this sounds complicated to you and it might be too troublesome for you to actually calculate, you can actually bring out this trade tracker feature in TraderWave, where you can just input all this number and will automatically calculate the number of units for you over here, which is in this case 40,000 shares, and that's how you actually can establish that you can actually buy along up to 40,000 shares, okay, in order not to risk more than 1% of your total capital in this case. Okay, so this is the right way to size your trade. And then finally, once you do that and you get into a trade, okay, you execute the entry level, you have your stop loss and you have your profit target. Now it's just simply wait for the move to materialize. Okay, although we think that there's a higher probability that it will go towards your profit target, but nothing is for certain. We just need to wait for it to happen. Okay, so you let the market decide the fate of this trade. So in this case, this trade actually did work out. After the bullish reversal candlestick patterns emerges, it actually went up higher and it went up all the way to our profit target. Okay, so this is the part I want you to accept and always remember. Once you get into a trade, you have no more control over how the market is going to do at all. Okay, the only control you have after you get into a trade is if it touches your profit taking level, you get out. That is what you have control over. If it doesn't work out and it hit your stop loss, you take a stop loss and get out at your stop loss level. That is what you have control. Other than that, let the market decide whether it's going to go higher or go lower from there. None of us can do anything about it. Okay, so I hope that this part of my step-by-step process, okay, is helpful for you to think from a perspective if you want to initiate a candlestick reversal pattern trading strategy, how you can actually do it on a step-by-step basis. Okay, I hope that was helpful for you. And if you are really keen to learn more about candlestick, of course, what I'll share with you is just a very generic and foundational knowledge about candlestick. If you want to learn more about candlesticks, okay, you can actually go and look for Steve Nison's book. He has very good books on Japanese candlestick charting techniques. In fact, he was probably the first person who learned about Japanese candlestick from the Japanese and write into a book in English to share with the Western world. Okay, so these are two of his very popular books about candlestick. If you are interested, you can go and have a look. And so some of the sources that I've managed to get the images from to put up this presentation today as such. Okay, so before I go on to the Q&A, I will leave about 10-15 minutes for Q&A. Before I go on to it, I just want to quickly share with you the next upcoming trading webinar, which is free of charge again. It will be on the 13th of June, and the topic will be how to find more opportunities using less time, okay? And that I'll be sharing with you my ultimate analysis workflow, okay? So I realized that a lot of traders have problems keeping tabs or keeping track of a big list of stocks, okay? And I'm going to share with you how you can actually use less than 15 to 30 minutes a day and still keep track and find good trading ideas using lesser time across a huge list of stocks, okay? So if you are interested to learn how I can do it and be very efficient about it, please sign up for this trading webinar on the 13th of June. Time will be the same, 8:30 p.m. Singapore time. Okay, and if you want to sign up for it, you can just Google for TraderWave Webinar Hub, and you will probably come to this Webinar Hub page. Otherwise, you just go to traderwave.com and look under Resources Webinar Hub, and that's where you can actually sign up for the upcoming webinars, as well as to view those previous webinars that we have conducted and recorded a video for. All right, so that's where you can learn more about it. All right, so what I'm going to do now is I'm going to go into Q&A. I hope that you have a lot of questions and you have been posting questions because Gladwin should have been tagging all these questions. So I'm going to go through as many questions as I can and try to help you understand more about candlestick, or if there's any other trading related questions, I will hope to provide you some answers on. All right, so just give me a few seconds to switch my screen. Okay, so okay, let me just bring it over. All right, so questions. Okay, first question from Chin. Can we use Japanese candlestick pattern for intraday trading? Seems not. Sorry. Okay. So earliest one is actually below. Okay, thanks for clarification, Gladwin. Okay, so to be fair, to those who asked the question first, from B-Man, could you please suggest what should be the timeline, like 5 minutes, 15 minutes periods for intraday trading? Okay, so my expertise has never been intraday trading. So I'm not an expert in intraday trading. The time horizon that I spend most of my time in when I was the chief technical analyst for OCBC and as well as for myself is more towards swing trading. So usually my horizon ranges from holding a position for 1 to 2 weeks to maybe 1 to 2 months, that kind of range. So intraday is not something that I'm an expert in. So I'm not sure if I'll be the right person to actually suggest to you whether 5 minutes or 15 minutes periods is better for intraday trading. All right. So for Ko, does the body color of the pin bar matter? A hammer can have either a white or black body. Okay. For a pin bar, it doesn't matter because whether it's a white body or black body, because in the first place, a pin bar has a very small body. Okay, so a small body, the opening and the closing are actually fairly close. Okay, so when it's fairly close, opening and closing price, that means that either black or white, it doesn't really have a much impact. The important thing for pin bar is that you want to see that it has a very long shadow. Why? So for example, in a bullish pin bar reversal pattern, you see a shadow going all the way up, right? And if you look at it from a market participant's psychology perspective, what happens is that when a pin bar happens, what happens is that opening price, the market actually push and rally all the way up to the intraday high, but somehow it didn't manage to hold at the level, because if it's meant to be bullish and the bullish trend is supposed to continue from there, it should actually close near to the intraday high, right? But in this case, when a bearish pin bar happens, it means that the price actually pulls back down all the way, very long way away from the intraday high, to close significantly lower compared to the intraday high, which means that the market actually gave up towards the end of the session. That's why you will see a bearish pin bar with a long shadow pointing up all the way to the sky. All right, so that is actually the more important thing to look out for. Long shadow, small body, the body, whether it's white or black, doesn't really matter. Okay. How to spot a meaningful support or resistance level? Okay, so this is actually very basic things about. This question was from Pranav. This is actually a very basic things about technical analysis. In fact, if you have not learned about how to identify meaningful support and resistance level, I strongly encourage you to go back to the webinar hub and view those of my webinar recording that touches on trend line and horizontal support level. So I have one whole webinar talking about support resistance level. So I think that would be a more useful way for you to identify support resistance level. But to put it very simply, how to find a meaningful support or resistance level? The most simple way to identify, let's say, for example, an important support level is when the price falls to a certain level, it bounces off. If it comes to the same level second time or third time, the more times it comes to the same level and it bounces off, the more important that support level is. As generic as possible, this is how to identify a very important or meaningful support resistance level. All right. So I hope I answered your question on that. Otherwise, strongly encourage you to go to the webinar hub and view the particular webinar on support and resistance levels. All right. So Natarajan, how are the volume related with the candlestick pattern? So generally, the volume doesn't help that much in terms of identifying the candlestick reversal pattern. Volume usually are more helpful when we look at a breakout of a key support or resistance level. It is not as useful as compared to looking at reversal during reversal occasions. All right. So volume, usually I will use it more for analyzing breakout situations. Okay. So for example, when you have a key resistance and the price couldn't penetrate that resistance level or the resistance line for a number of occasions, but when it finally penetrates the resistance line accompanied by surge in volume, that's where it's very important. Without the surge in volume, there is a less likelihood that the bullish break will continue to go higher from there. All right. So that's how volume I actually use, but not so much with candlestick pattern itself, because for reversal pattern, volume might not be a critical factor. Could you please advise on MACD pattern to look along with the candlestick pattern? So for moving average, well, one thing I got to share with you first is that firstly, you cannot use a single parameter of moving average for all the stocks that you look at. Okay, the reality is every stock has a characteristic of its on its own. So for a stock that 100 days moving average, it tracks the 100 days moving average very well for one stock, doesn't mean that all other stocks will track the 100 days moving average very well. So you got to look on a stock to stock basis. Firstly, which moving average does this particular stock rebound off very nicely, okay, on its way up? And how you can actually use moving average or MACD, oh sorry, I thought it's moving average, so it's actually MACD, all right? So MACD, well, just make sure that MACD actually is confluencing together with the candlestick pattern. So let's say, for example, if you are seeing a bullish candlestick reversal pattern emerging, okay, and you take a look at MACD, you don't want to be seeing the MACD is still persistently going down, because that becomes a divergence in a way, all right, and that might not actually help to support confluence factors, all right. So you want to see the MACD starting to turn back up as well, or even leading on its way up, and you see a bullish candlestick pattern emerging. That's when it suggests to you that there's two confluencing factor that could potentially increase the likelihood of this bullish reversal happening, all right. So next question by EK. You said to use reversal pattern in line with general trend. Look for the bullish reversal in an uptrend. Is there any use for looking out for bearish reversal in an uptrend, say, to find out where to get out of a trade because it's starting to do against you? Yes, exactly. So you can actually, in this case, you can use bearish. Let's say if it's in a major uptrend, okay, you are holding on to a long position, you can actually make use or potentially or look out for bearish reversal candlestick pattern to help you take profit. Okay, especially when you see a bearish reversal candlestick pattern happening at a key resistance. So there's two confluencing factor, right? Happening at a key horizontal resistance, for example, or key psychological resistance. Then that's when you can use that as a method to get out of a trade. But this will mean that you can't actually establish a profit target level right from the start of when you enter a trade. You will have to hold back on your profit target level first for now, and let the market slowly emerges, and then you watch out for a reversal, bearish reversal candlestick for you to actually take profit. All right, so I hope I answer your question on that. From Murli Krishnan, does it work on day chart or week chart? Usually I will use day chart, okay, but week chart it can be used as well if you are a long-term position trader. If you are a long-term position trader, which means that usually if you hold your trades for at least 6 months to a year or even longer than that, okay, you can actually use a weekly chart or weekly candle and look out for bullish or bearish reversal candlestick pattern on a weekly chart. Okay, you can actually use that if you're a longer term position trader. Okay, from Natarajan, can you advise whether the trailing stop loss can be placed in this chart pattern so that we can get the better of the upward movement of the trades? Okay, so if you're already using trailing stop, you're actually more advanced already. All right, so for trailing stop, once you place the initial stop loss based on this reversal candlestick pattern, then as the price move higher and higher and higher again, and you start to see the emergence, okay, so you have not gotten out of trade, you don't have a profit target, but you see an emergence of another bullish candlestick reversal pattern happening during the minor prior downtrend again, during the pullback itself. You see a bullish reversal candlestick pattern happening again. You can actually move your stop loss into slightly below the next bullish reversal candlestick pattern, which means that now it becomes a trailing stop. Okay, so you can actually do that as well. So that's a good question and a good point. I hope you understand what I'm trying to say. All right. Can we use Japanese candlestick pattern for intraday trading? Again, so that's not my forte. I can't advise you whether candlestick pattern is actually helpful for intraday trading. In the summary image in bearish, it should be inverted hammer. Yes. If we are talking about a bearish reversal, yes, we are looking at an inverted hammer. That's right. So Pranav, in a bullish engulfing pattern, does the second body have to engulf only the body of the previous candlestick, or does it have to engulf the entire candlestick, including a shadow? No, you just have to engulf the body will do. You don't have to engulf including the shadow itself. Okay, it's just the body, right? What is your preferred time frame in application of these candlestick patterns? Candlestick pattern, okay, usually candlestick pattern, if you look at a daily candle, Okay, it is more useful for swing trading, which means that you are looking to get into a trade and swinging over the next within 2 weeks, 4 weeks, or up to a month to 2 months. Okay, that kind of trading horizon. All right. So if you're using a daily candle, you're looking at anything from 2 weeks to a month or two. Right. How to do a trailing stop? Just now I shared already. Woo. Candlestick useful in a range trading market? Okay, good point. So just now I from UK, is candlestick useful in a range trading market? So just now earlier on, I was saying that ideally you want to get into a candlestick reversal trade if the major trend is together in line with the reversal direction as well. All right. So there's one scenario that you don't have to be in a major trend, is that the major trend at least should be in a sideways trend. Okay, so if let's say the major trend right now is in a sideways trend, it keeps coming back to, let's say, $1 support level. Okay, bounce off one time, then it goes to all the way to $2, $3. Then after that, it pulls back to $1 again, and then suddenly you see a bullish candlestick reversal pattern happening at the $1 again. Yes, that could potentially be a way for you to trade a range trading market using candlestick reversal patterns. Okay, but that is as far as it goes. If it's in a clear major downtrend, don't try to trade a bullish reversal candlestick. Okay, because the reward to risk ratio will not be worth it. Right? Okay, next question from Joseph. Shall stop loss only confirm when the price closed? If it's bounced in midday, would it be stop loss too early? Yes, usually I suggest that stop loss level, it should be towards the close. Okay, so let's say, for example, your stop loss is at 90 cents, for example. Let's say right now the price has fallen from your entry level. It is coming to about 91 cents. Then it comes to 90 cents intraday today. Okay, so by right, it touches 90 cents intraday, right? Should you get out yet? My suggestion for you is no, not yet. Why? Because intraday, although it touches 90 cents, there's a good chance that it will pull back by the end of the day, right? So my suggestion for you is this. If let's say during intraday, the price has come to your stop loss level already, don't get out first, okay? There's only two scenarios where we will look at getting out at the stop loss is, firstly, towards the end of the day, maybe just 10 minutes or 5 minutes before the market close, is the price still at 90 cents or lower, okay? Because if within 5 to 10 minutes of the market close, the price is already and still hovering at your stop loss level or even below your stop loss level, then you could look at just getting out at your stop loss level towards the end of the market day. Okay, if you do not have time to exit your stop loss in intraday before the market close, then the suggestion is wait for the market to close, see whether the closing price is at your stop loss level or below. Okay, if the closing price is at your stop loss or below, then next day opening, market opens, just get out from there. Okay, that's my suggestion for you. Okay, two occasions, either you get out just before the market close or you get out after the market open on the next day. Okay, and question from Edward. When a reversal is established, what then are the patterns to forecast the duration and extent of the new trend? Well, there isn't a very easy way to forecast the duration and the extent of the new trend. That's the reason why on my 7 and 8 point is that once you establish a likelihood that the reversal pattern is likely to materialize, the only thing you can do is make a bet on it. Have a stop loss, risk manage, and then let the market work its way. Okay, the market will tell you whether it's going to go higher or go lower from there. Okay, and just let the market tell you what to do, or tells whether it goes to your profit target or hits your stop loss, and then you just get up accordingly, according to what the market says. But if you are diligently using confluence factors together with candlestick reversal patterns, usually you have a higher chance of being right on the reversal itself. Right? And okay, from ASD, assuming a pattern is achieved with a confirmation on the third day, what if the fourth candle breaks the pattern? Do you ever give up a trade early before stop loss is reached? Okay, good question. Once you get into a trade based on all those factors that I shared with you earlier on, you have already established your stop loss. Okay, don't worry about if the fourth day it starts to pull back a bit or what. Okay, as long as the pullback doesn't go all the way to your stop loss, you continue to hold on to it. Okay, that's my suggestion, because there are a lot of occasions where you see a confirmation already, it might not just straight away rally all the way up from there. When you see a confirmation, sometimes you will see a minor pullback again, back to the support level, and then before it bounces off again, which is perfectly normal. Okay, so in this case, my suggestion for you is, once you get into a trade, you know where your stop loss is, just follow your stop loss. Okay, only move your stop loss higher. If it doesn't touch your stop loss, then no need, there's no reason to get out. Okay, give it some space. The whole point of having a stop loss is to give the price some space to fluctuate before it starts to trend higher from there. Okay. Question from Qin. What is the most important of the candlestick pattern for the reversal? Not quite sure what you mean by this question. Okay, I'll skip to the next one. From then, other than candlestick pattern, support resistance level, what other indicators would you recommend to use together? Well, personally, I don't really like to use technical indicators and overlay. Things like MACD, RSI, personally, I think they are a derivative of the price action. So usually my personal preference is still towards just using candlestick reversal pattern together with support resistance level and trend lines and trend channels. At most, I bring in things like moving average to further help to establish what is the major trend. That's about it. From Wu, if buy a stock going uptrend, then suddenly go against you and goes downward, when to cut loss. Okay, so I've already shared with you how to set a stop loss based on candlestick reversal patterns. All right, so just watch the webinar video again to understand where exactly to put your stop loss. And last question from Ronnie before we end off today's webinar is, can we actually use candlestick pattern in confluence with Fibonacci retracement level? Yes. So if you think about it from a Fibonacci retracement level perspective, a retracement is a Fibonacci level retracement level is basically another support level. Okay, so a horizontal support level is based on what you see on the price action. Okay, where you identify. So retracement is also another confluencing factor to suggest an alternative support level or alternative resistance level. Okay, so if let's say for example you see a bullish candlestick reversal pattern emerging at a key horizontal support level, at a key uptrend support level, at a key Fibonacci retracement level, that's the best of both worlds, of all worlds, because you have 4 confluencing factors happening at the same time. Okay, so of course, otherwise, if you have a missing support level or missing uptrend support level, but you have a bullish reversal candlestick pattern together with a Fibonacci retracement level, which is meant to be a support level as well. So with just these 2 confluencing factors, do you think you want to take a chance on that? If you think you want to take a chance, go ahead. So again, there is no right or wrong answer. But ultimately or generally, the important thing to look out for is, do you have at least about 2 to 3 confluence factors to help you make a more informed or more conviction trade in order to get into it. All right. So yeah, so I have answered basically the last of the question from Ronnie, and we already exceeded the time by about 15 minutes. So I hope that today's session on candlestick reversal pattern has been helpful for you, at least from a more foundational knowledge perspective. So if you are keen to use candlestick reversal patterns as a form of analysis to help you get into a high probable trade, then just focus on becoming competent with that 5 different kinds of reversal patterns that I've shared with you in today's webinar. Okay, after you become very familiar and you can spot all those patterns easily whenever you look at any charts, that's when you can start to look at the more other types of candlestick patterns. But generally, well, my personal preference is you don't really have to look at the other of the candlestick reversal patterns outside of these 5 main types, right? Just be very good with these 5 main types and look across more charts. That will be more than enough to help you find viable and good trading ideas out there. All right. So I thank you for your time today. Oh yeah. So before I go, I just want to quickly share with you the offer. Okay. I almost forget about the offer itself. There's an offer I have for those of you who are okay. Sorry, I'm looking for where that. Okay, so okay, so as I shared earlier on, of this offer for those new users, those of you who are not, the bulk of you actually not TraderWave users at this point in time. So I have a special offer for all of you right now is that if you sign up to become a TraderWave user by 6th of May, okay, via this link that I've given you, traderwave.com/webinar bonus. If you sign up for a TraderWave account using this link before 6th of May, you will actually get additional 1 month free usage of the Pro plan, which allows you to set up to 300 alerts and having 5 watch lists, as well as being able to see a longer historical data of the stocks that are listed on 16 Asia Pacific exchanges right now. Okay, so if you are keen to get an additional 3 months of usage of this Pro plan, please head to this link, traderwave.com/webinar bonus, and sign up, and automatically we will launch you on a 14 days trial of the Pro plan, as well as add on an additional 3 months to it, so that you can get to one more month of trying out the Pro plan itself. Okay, and just one thing to take note: once you sign up to get this free usage of the Pro plan for additional 1 month, please do not change your plan during this period, because if you change, then the 1 month free usage will disappear. There is some architectural issue that we might have not been able to resolve. So just make sure that if you accept this offer by signing up at this link, please do not change your plan over the next 1.5 months, okay, so that you can continue to use this 1 month free usage of the Pro plan. All right, so this is my offer. I hope that it will be helpful for those of you who is not a TraderWave user yet. So go ahead and try it out, and even if you decide not to upgrade by the end of this 1.5 months, you can still actually use the free version of the TraderWave thereafter. Okay, so I hope that will help you be a more efficient trader and help you to find more good trading opportunities from there. All right, so that's about it from me, and I hope you have a great day ahead, and I see you at the next webinar. All right, take care. See you. Bye.